Today we're going to talk about how the IRS calculates penalties and interest, and how this can spiral out of control over time. Many taxpayers think that IRS penalties and interest are minor add-ons. In many IRS cases, penalties and interest can exceed the original tax owed, sometimes dramatically. And the most dangerous part? They compound automatically, silently, and relentlessly. Today I'm going to explain how the IRS actually calculates penalties, how interest keeps growing, and why waiting almost always makes things worse. The IRS generally doesn't apply one penalty to start with. They stack them. Here are the most common penalties: failure to file penalties, failure to pay penalties, accuracy-related penalties, civil fraud penalties, trust fund recovery penalties for payroll cases. Each one of these penalties has its own rates, triggers, and timelines. Failure to file can reach 25% of the unpaid tax over time. Accuracy-related penalties can add another 20% to that. Civil fraud penalties add 75% to any understatement deemed to be attributable to fraud. None of these penalties are negotiated up front. They're assessed after the fact, often once the IRS already believe it has leverage in the case. Let's talk about IRS interest compounding. IRS interest compounds daily. It applies to both the tax and the penalties involved, and it continues until the balance is paid in full. Even if you file an appeal, enter negotiations, dispute the assessment, interest keeps running. This is why taxpayers are shocked when "I only owe $40,000" becomes "now it's $85,000." Because time and unpaid balances are the IRS's strongest weapon. Audits and other delays just make things worse. Here's where many taxpayers accidentally hurt themselves. During audits or disputes, deadlines are missed, partial payments aren't structured correctly, penalty defenses aren't preserved. The IRS makes the assumption if you didn't respond correctly, the penalties apply, period. Once assessed, penalties become much harder to remove, and at that point you're no longer arguing facts. You're basically trying to attempt damage control. So how can someone like me reduce penalties? Well, penalties aren't always permanent, but they must be challenged early, correctly, and with legal positioning. Possible relief options include the following: reasonable cause defenses, including reasonable reliance on a tax professional. Or you can drive down the original assessment and penalties and interest will proportionately follow. We do this through litigation all the time. Or through strategic appeals, settlement positioning, and first-time penalty abatement. Also, proper use of voluntary disclosures and other IRS programs where applicable can reduce penalties and interest. This is not about begging the IRS. It's about knowing which penalties are legally vulnerable and which ones are not, and how to stop interest from compounding further over time. So why does dual licensing of a tax attorney CPA matter here? Well, this is where most taxpayers make a very costly mistake. Listen, CPAs are excellent with calculations. I have a staff of them. But CPA communications are not protected. Once penalties escalate, any emails, any drafts, any explanations, the CPA's file can become discoverable evidence. Where, on the other hand, a dual licensed tax attorney and CPA controls privileged communication, coordinates accounting work safely, and negotiates penalties and interest strategically. We also protect against civil cases turning criminal. When penalties and interest start compounding, you need both legal protection and technical mastery. So in closing, IRS penalties and interest are not accidental. They're designed to apply maximum pressure and to teach taxpayers basically what not to do. The longer you wait, the more leverage the IRS gains. If penalties and interest are already stacking, or you're facing an audit or assessment, whatever you do, don't guess, don't delay. Speak with a dual licensed tax attorney and CPA before the numbers spiral further out of control.